If you are someone that has a full-time 9 to 5 job or a part-time job and you are always frustrated because you can't manage time to trade the Forex market, then this video is going to be for you. Here, I'll be showing you a step-by-step strategy that is very simple but yet powerful at the same time. If you apply this properly, you can see consistent results, not only financial-wise, but also confidence-wise. This strategy will allow you to gain familiarity with the market on a daily basis, to eventually help you to transition slowly on understanding how you can become a full-time trader. So let's get started. So the first thing you can notice today, all right, is that there is no time frame above here. Exactly, it's hidden, and you can see that we are on RGBP chart right now, and there's no time frame. So how come? How come there's no time frame? And I want you guys to understand this. What I'm going to show you is so powerful, right? That it's gonna give you such a crazy breakthrough. Now, many times people fail to understand that price is fractal. All right, this is the most important things that a lot of people don't understand. Price is fractal. Okay, so what do you mean by price is fractal? That whatever happens in one time frame, all right, it happens literally in every single time frame. So it's not that 4 hours is doing something and 5 minutes is doing something else, or 15 minutes is doing something different. No, they all move to the same exact way, and this goes down all the way to 5 seconds. So if I show you this, right, literally what we got right now on the chart, and I say to you, tell me the time frame, you can tell me, because unless you don't see the time frame bar above, you cannot know what's going on over here, right? But what you know is that price is going up and it's going down, it's going up and it's going down. So that's exactly what is happening over here. So now, why this is important is because, unfortunately, that's the reality, and that's what is happening nowadays, is that social media is destroying a lot of traders. Like literally, that happened to me as well. When I started my journey, right, I got influenced so much by the social medias, the things I was seeing from everyone. And unfortunately, nowadays, everybody on social media are just doing like intraday scalping. They're trading Asian high, Asian low, previous daily high, whatever, ICT. Like there are so many ways of trading, but long story short is that everybody are just like doing intraday. And by doing so, when they're doing their prop challenges as well and all of that, they are showing everyone that in order for you to be profitable, you have to trade intraday. You have to trade a smaller time frame. Right, smaller time frame, because there are a lot of narrative, there are a lot of story. So let's say, for example, if someone is trading liquidity and this is your liquidity box, right? If this happens in 5 minutes or 15 minutes, or let's say in 1 hour time frame, a lot of people will be buying over here, targeting over here, or probably a lot of people will be selling over here. Now the liquidity has been taken, and then targeting over there, like to the downside. And usually, if you are intraday trader, you probably trade the London session, the New York session, the Asian session. So if let's say that this is your Asian session, right, and you're someone that has a 9 to 5 job, how on earth are you supposed to trade? Let's say you're on a train, you're going to work, and then boom, the Asian low gets taken out. Like what in the hell? How are you supposed to open your cell phone and monitor that, right? And I've seen a lot of people getting frustrated over the last few years probably, where people are like, I can't trade because of this and that and blah, blah, blah. All right. So in this video, I'm going to show you that you don't need all of these. You don't need the liquidity, the Asian high, Asian low, the London session. You shouldn't be even caring at all. Because if I tell you now, so tell me what time frame is that, you wouldn't be able to know. All you know is that it's 0 GBP. I also told you that this price over here can be the Asian high and the Asian low. And you can see the liquidity gets taken out and then price targets all the way above there. But look, let me show you this. If this was supposed to be Asian high or low, this box over here, right? How many hours do you think that will be? 6 hours, isn't it? But if we check from here, which is Sunday the 28th, and this one is Monday the 12th of February, what is this telling you? There's actually the same thing that I'm telling you about the Asian high, Asian low is actually happening in a larger scale, in a weekly time frame, in a monthly time frame. So that is saying that if you now switch your perspective, your point of view, you can literally say, okay, the liquidity has been taken down here, right, in a higher time frame. That can be a weekly low, let's say. Now I'm targeting the weekly high. You see how the perception is changing now, the perspective is changing, right? So this is very important, because if you don't acknowledge that, the fact that time is fractal, that everything happens in the market is literally fractal, right? You will never be able to satisfy your psychology. And on the top of that, you'll never be able to actually trade with something properly when it comes to 9 to 5. Now, today, what I'm going to show you is that the price, the fractality of the price, it creates what? The structure. And the structure has also what else it does? It moves from a supply and demand zone. So the strategy I'm going to show you now is purely based on price action. And there is no, oh, I'm guessing here, I'm guessing there, I'm guessing whatever. No, there is no such thing. And then on the top of that, I'm going to be also giving you a very, very simple entry model that is purely based on one single tools that a lot of people underestimate a lot, unfortunately. But the reality is that it works like a charm, and it works very, very, very well. And that, combined with the pure price action, the pure price structure, right, it will help you to get the ultimate strategy that you need to be using while you're working. So what is that? I actually made a previous video where I talk about this strategy, but I went in depth showing you the power of that. Well, today I'm going to be helping you to show you how you can implement that. So let's start with the price structure. What did I say? So if this goes high, it goes low. What we know is that every time that we have a new price creating a higher high over here, we can see at one point that price does what? It retraces, right? So you're trading on while you're doing your 9 to 5 job, first thing first that you have to understand that you have to always start with a higher time frame narrative. Forget about 5 minutes, forget about 1 minute, forget about, let's say even 1 hour. Stick to 4 hour and daily. I think 4 hour daily is the sweetest spot that anyone can use while they're doing the 9 to 5 job. And I'm telling you, because 4 years ago when I started, I was just trading 4 hours. I like literally 4 hours, 1 hour, and to be honest, I had like over 10 pairs and everything was manageable because I don't know, I just learned it that way. Because when I started doing 5 minutes, 15 minutes, it wasn't actually working really well for me because I was frustrated. I had to go to the toilet every 5 minutes to check out my MetaTrader and all of that. It was crazy. But when I switched on this, and now I'm telling you the first point of your strategy, which is like the 4 hour time frame, or let's say all the way to daily, right? So daily time frame, weekly time frame, that's going to be definitely your best friend if you're someone, right, that has a 9 to 5 job. Now, you can also go to 1 hour. It's not that bad at all, like 1 hour based on, your circumstances. If you're someone that's doing work from home, or if you're someone that, has plenty of time in your workplace, then 1 hour should be fine as well. Now, nothing below that, absolutely nothing below 1 hour, nothing below 4 hours. Stick to this time frame. So the most important thing are this time frame. Secondly, identify your price structure within this time frame and the narrative. No worry, I'm going to be showing you everything on the chart because I promised you step by step. But now I'm showing you just the general overview. So let's say that this is a 4 hour structure. So right now, price is going higher. So therefore, your objective has to be buying from somewhere around here, right? From a demand zone that allows you to have the next what? Impulse to the upside. So how do you do that? Now, for a starter, there are so many ways you can do that. You can use the order block, you can use the demand, you can use the imbalance, whatsoever. But one thing that I suggest you to do is going with this simple but yet powerful tool, which is the Fibonacci. And again, guys, I made a video if you guys want to watch it because I explained very in depth on the logic of why Fibonacci is very, very powerful, especially when it comes to smart money trader as well. But using in conjunction with the price action is a whole new level, okay? But don't worry, I'll show you on the chart. Now, when it comes over here, one thing you guys have to understand that price moves in two key factors, right? We have the expansion phase and we have the retracement phase. So whenever price is retracing, you have anything that goes below from the 50 all the way 100 down here is a very, very sweet spot for you to take a trade. But one thing that many people don't realize, that don't understand, is that those numbers over here are ideal for you to take a trade, okay, on a retracement phase of a move. But how about the expansion phase? How far can the expansion go to? So usually the expansion, the ideal number used mostly from the retail trader are minus 27 and minus 61. And I can promise you that if I show you now, and I'll show you in a bit, the power of minus 27, minus 61 in conjunction with the liquidity concept understanding or fair value gap or imbalances, they work like a charm. Okay, and nothing in the market are random, and that's just the craziest thing. So what happens is that a lot of people be like, yeah, but minus 27, minus 61, or like, why are you showing, man? Well, don't worry, I'll show you on the chart so you will see. But then knowing that minus 27 and minus 61 are ideal as for your expansion phase is not only helping you to understand where is the target, but it also helps you with something very, very important, which is your risk to reward, right? So now, for example, in this case, let's keep it, actually, you know what? Let me remove this Where is that? Let me remove this one, right? So now, as we said before, this is our 4-hour chart. In case you forget it, let's type it here, 4H, right? So this one over here is a 4-hour chart. Now, we have a retracement. We have 3 key levels over here, 50, 61, 78. Now, why I'm showing Fibonacci instead of showing you some crazy refinement? The reason for it is because if you got 9 to 5 and you're about to head in a meeting, you see a new high and you see the retracement starting, you just pull the Fib, you know the levels, and you place the trade. As simple as that. You don't have to overcomplicate things. So now let's say that if we were to select our 50 level, what can happen is that the very next target, what did I say before? The expansion phase, it comes all the way to minus 27 and minus 61. So entering on the 50 level and exiting on minus 27 is giving you already a 1 to 51 risk to reward ratio. If you target all the way above there, it's going to be minus 61, which is for 2.6 RR. So what you have to acknowledge over here is that higher is your entry, higher is going to be your win rate. Okay, lower is your entry point, like here and here, then lower is going to be your win rate. However, if your win rate is lower, your risk to reward is higher. This is a mathematical proportion that happens all the time within the trading industry, right? I mean, if you have a high win rate, then you have a low risk to reward. If you have a low win rate, you have a high risk to reward. So in this case, if you go from 61, so I'm showing you 3 levels now, you can see that already on the first level, minus 21, minus 27 is a 1 to 2 risk to reward, and then minus 61 is a 3.12, but let's say a 3 risk to reward. And finally, the last level is 78. Now the 78, already you can see the minus 61 is giving you a 6 RR, and then on the minus 27 is giving you 1 to 4 risk to reward. So what I would say is that now that I'm showing you the different step of the strategy, which is choose your time frame, 3 time frame, key important one, understanding your direction, okay, buy, bullish or bearish, and then choose your 3 entry points. So you go 50, 61, 71. Now it's literally up to you, right? How would you manage your risk? I wouldn't say to you, oh, get the 61, get the 78, or get the 50. No, you can get the 50, you can get the 61, whatever suits you the most, or whatever gives you the most comfortableness, then you can target your minus 27 and minus 61. That's it, as simple as that, guys. Like literally 3 steps: time frame, direction, entry, and target. Actually 4 steps. Okay, that's all you need to know. And this simplistic approach, if you apply it on a consistent basis, you can literally first thing first start gaining a lot of confidence. Why? Because you're familiarizing yourself with the direction of the market, with the understanding of the different levels, with the understanding of the different exit point, with the understanding of the different entry point, and of course the stop loss, which is going to be always underneath the supply or demand zone. Okay, so now you might be saying, oh, this is just a drawing. Okay, let's go to the chart, and I have this pure crazy price action over here on 4-hour average GBP. This is, by the way, a 4-hour chart. All right, so that's why I said before, tell me what type of chart can you see, what is the time frame. So what's going on over here is that if you zoom out a little bit, right, you can clearly see that as of now, price over here, this price action, just looking at the 4-hour chart, you can see that from this zone over here, starting from this level, price started showing a very intentions of doing what? Keep going to the upside, right? So now the price came over here. You can see the order flow is bullish till this level gets broken over here, right? You can see that we break this structure. Now, if we break the structure, what is the next thing you can expect from the price to do? A retracement. So that's the beautiful thing about the higher time frame, is that you can not only trade the pro trend, but you can also trade the retracement. But this retracement, by the way, careful. That's why I said to you before that you need a 4-hour and a daily time frame. This retracement and this structure that I'm showing over here, this is a daily time frame. So now that you know that you are somewhere around here, right, on a daily time frame, you can now wait for what? 4 hours to show you the intention of initiate the retracement of the daily time frame, right? And how do you do that? You just wait for the simple price structure break to one direction, which is above. So in this case, you can clearly see that price in a smaller time frame, it started coming here, up and down, comes here, and then boom, it breaks the structure. So what do you guys know now? You know that price needs a retracement, and the retracement can happen. You can use imbalances, but again, you can use some sort of things like Fibonacci, or you can use order block, whatever. But you know, for a traditional way of thinking, is that usually when you are a support or resistant trader, or you are a reader trader, you know that every time that there is a break, there is a test as well. So if you have a break and the test is missing, in this case, this test over here, that itself is already telling you that there is a target, there is a room of the retracement to come higher, right? But instead of forecasting all these crazy things, all you gotta do is just follow your price structure. So what do I mean? Is this price goes up, it goes down. Now, if you follow the logic of the structure and the logic of what I explained to you before, you can clearly see that if you were to take the 61 or 50, 2 out of 3 level would have been already taken. So that itself for you could have been a very, very nice entry point from here to here, and the target could have been a minus 27, as I said before, for a nice 1 to 2, or a minus 61. In both cases, all right, you can see the price has hit what? The targets. Now, let's say that the very next day, right, you still follow the price. So you see that there's a break to the upside. Guess what? And that's the beautiful things of trading higher time frame. And if you got 9 to 5 job, is that you don't have to have a fear of, oh, I'm losing an opportunity, I'm losing a trade. Because if you're taking this trade, which is like roughly 10 o'clock, I can promise you that by the time the price creates a new high and then it retraces, another day will pass by, right? So what do I mean? So you can see here, for example, this is the 15th of Friday, December, and the very next setup that we have is the 19th. So you have the whole time of the world for you to place another trade over here. And guess what? Wow, we get another 61% entry, right? Again, you can take it on the 50 level, but I'm just showing you now on the 61 level, or even the 78 is up to you. And then again, minus 27 and minus 61, and you can clearly see price has reached the target, right? You guys see how I'm showing this? Like literally this, what I'm showing you over here is the same exact thing that I did on the drawing. So you guys can say, oh, he just did the drawing. No, literally no, because I'm showing you now step by step. By the way, I'll show you also what you should be doing when things goes wrong. Okay, so don't worry, okay? Now, you got this low, you got this high. Again, you can see there's a retracement, nothing that's hitting on the 50 level, so this is a miss. But what do? You don't forecast, because now you can see the price has already reached this important level. It could potentially go even further higher because probably there's a liquidity, there's imbalances whatsoever. But again, you don't need to forecast. You just follow the structure. What do you do with the structure? Well, price breaks to the upside. Then again, you pull your Fibo, right? We got another entry over here. Same story, same thing. Here is the 61 level. You take the trade over here. You place your stop loss down here. And then you target again minus 27 and minus 61. Now, let's go to this one. It's going to be very, very interesting. Over here, okay, oh, by the way, there's another setup over here. You see, this is just crazy. You go setup after setup just using 4 hours. This one again is from 61. You see, tap the 61. It comes minus 27. It doesn't go to minus 61, but it's fine. Now, let's say that here you're still following the structure, right? So you're like, oh, there's a bigger structure to the upside. Now I'm taking the trade. So what do is that if you pull the Fibo, this is a stop loss. And this is something I want you guys to understand, is that here you've been following the trend, okay? You didn't do any guesswork. Why? Because you know that we are bearish. We broke to the downside, right? In a daily. So we're expecting a retracement. How do we get the retracement? Following the structure, right? Step by step. But at one point, you have to be aware that this retracement is going to change. And when that's going to happen, what do you guys think is going to happen? You're going to hit a stop loss, especially if you go back to back, right? So that is absolutely fine. Why? Because even if you hit a stop loss over here, who bloody cares? Why? Because he had a 1, 2, 3 over here. He had a 1, 2, 3 over here. He had a 1, 2, 3 over here, right? So that itself is like 3, 6, 9% over here, thinking that, you know, you're risking 1% of your trade. Then when you hit a stop loss over here, that's absolutely fine. You now do the same exact thing in the opposite way. And you can see there's a structure marked over here. High, low, right? So here, you take the trade and you start doing the same thing again. How far? Now you know that price broke to the downside, it retraced. Most likely, this can be now the part of the expansion phase. So we probably now gonna go all the way down here. Maybe. Why maybe? Because sometimes you have this breaker structure to the downside, which is simply liquidity up, and then price keeps going to the upside. But then again, you do what? You just follow the structure. Now you get out of your house, you get to work, you place a pending order, forget about it, and that's it. The next thing you know, price goes and hits TP again. Why? From here. So do you really think that this one stop loss should be bothering you? I don't think so, right? You can clearly see that price makes another 1, 2, 3 nicely. And then the same exact thing, I'm not going now step by step all of them, but you can see literally again breaks to the structure, another entry, break to the structure, another entry, break the structure, no more entry. Now you might be saying, yeah, but this is, you know, old because it's from December. How about now? Well, it's the same exact thing. Look again. What? Look at this low that gets broken. What do we expect now? The retracement, right? So what do you guys think is gonna happen? Look at this. Price comes here, breaks to the upside, 4 hour. You pull the fib, you take the trade. Now here I want to discuss something very important, which is the risk management side and the psychology as well. So here you got the trade, you try to take the trade from, let's say again 61. I don't know why I'm always doing 61, but yeah, you can do 50, 78, whatever. And you can see the price fails to do what? It fails to come to minus 27, minus 61. But that's not the end of the world. Why? Because let's say the price comes over here. You can clearly see that here itself is at 1.55. At this point, you should be doing two things. You either go break even, or you take partial and you let the rest run it out, right? And this goes to the part of the risk management of the strategy. But this is something that I cannot personally give it to you right now. You need to figure out by yourself. And how do you figure it out? Try always to keep your losses low. Okay, this is very, very important. Why? Because let's say now, forget about all this trade. Let's say for whatever reason you had a couple of losses over here, right? 1 or 2 losses whatsoever. As soon as you got a new high, you could potentially take partial 50% out of the trade. So it's a 1.5, so you get roughly 0.70 or something, and then you go break even. So in this way, you already know that you secured some losses from profit from the previous losses, and the rest you just let it ride all the way above there, right? But this is something that comes down to you. You need to play out and understanding how you should be doing this. If I can say my honest opinion based on my experience is that I personally don't used to take a lot of like partial, because partial helps you to basically psychologically relieve yourself to say, okay, I'm managing things, so you're growing consistently, right? But when it comes to take the full volume, then you're gonna hit a lot of losses. And why I say that, it's not that you're gonna hit a lot of losses, you're gonna see more losses, and that probably gonna affect you a lot psychologically. So here you got losses, that's fine. Then what happened again is that price goes up, it goes down, it goes up, it goes down. You take the trade, you hit the losses. But then if you follow again this structure, right, you can clearly see the price action is doing what? Going up, it's going down, it's going up, and boom, there you go. You got another trade, right? How? Because you're following the 4-hour structure now, right? So you pull the fib again, you can see that we are still out of this, so we are expecting the retracement, and then you take the trade. And guess what? You didn't play out over here, but it's playing out over here now, right? You guys see what I'm showing over here? 1 second. Let me remove this. Okay, cool. There we go. So place an entry over here, place the stop loss over here, and then bam. Next thing you know, again 1, 2, 3, 1, 2, 4, whatever you want to do it. So now you guys understand that the key important part of this strategy that I've just shared with you and that showed you is that I'm not saying that you have to jump on this because you want to make crazy money. Because look, I literally did a back testing over here with you, right? So you're gonna hit losses as any other strategy. You need to acknowledge that. It's not that this is bulletproof, but what I'm showing you is that this gives you flexibility. First thing first, to familiarize and understand how the price behaves all the time. And you can choose 4, 5, 6 pairs, 7 pairs. It depends the way you can monitor certain things, right? Secondly, you don't have to have the fear of missing out anything, because by the time the price breaks through the downside and it's racing, trust me, 24 hours will pass by, so you will have enough time for you to take decision and place your pending order. You don't have to be on the chart. You can literally leave a pending order to take this type of setups. And then thirdly, the most important factor is that psychologically you can start feeling more of, let's say, power over your trading journey, right? Because now you got control time wise, trading wise, risk management wise, and all of that. So this being said, I really suggest you to focus not only the technical that I just showed to you now. So if we do a quick recap, right, we say that these are the 3 time frames that we need to look for. We need to understand which part of the phase we are, if we are expansion phase or we are retracement phase. And then once we understand that, the next thing we have to do is just pull the fib, right, low to high, decide which level we want to use. By the way, I suggest you to use only one level, right? Or you can use both of them. It depends the way you feel very comfortable. And then place an entry, go to sleep, forget about it, go to work, forget about it, set and forget, literally, okay? And then by doing so, you will be able to literally then start building even a lot more confidence. And one thing I want to mention is that a lot of time price will not be clear as the way it is over here, right? So you guys can see how clean is the price action, right? You can see high, low, high, low, high, low. And the very reason for it is because many times you can see very messy price action, right? So if we go, I don't know, somewhere over here, it's still clean. And then, yeah, it's very clean. But what I can say is that many times price is not like this. It's very messy, because the structure, you're never going to see it like this, the way a lot of people promotes it, right? People be like, oh, this is the high, this is the low, blah, blah, blah. Because the reality is that structure, most of the time, if not majority of the time, is like this, right? So you need to be very good on understanding what's going on, how to understand all this confusion over here in order for you to say, okay, I'm taking the right exact trade for me. All right. And how do you do that? Well, in order for you to know how you can turn this mess into this, then make sure you watch this video over here, because in this video I literally show you step by step how you should be turning that specific structure in the most cleanest way possible for you. This being said, I'll see you to the next one.